Thank you very much, Caterina. I also would like to thank the organizers for putting this paper in the program. It has been fantastic so far, and I also congratulate you for resisting up to now. This is a joint work with Lukas and Matthias Meier. I'm now at the ECB, so it's first time actually that I'm saying this, so I have to get used with this. This means that these views are only our views, and they do not represent the views of the European Central Bank or the Euro system. So we heard two papers about monetary policy shocks, and the story evolved in other on the transmission. So this paper actually is going to bring the attention to monetary policy shocks themselves, how we identify them, and what are the challenges with regards to this identification. Is actually fair to say that empirical monetary policy shocks are the backbone of monetary economics, are the bread and butter of many of us that work on monetary policy questions. They are used to assess the effectiveness of monetary policy. They are used for structural estimation. They are also used to do counterfactual analysis. What if there was this regime of monetary policy regime? What if there was this other monetary policy regime? And as for to do this job, let's say the best possible, we need the best monetary policy shocks. So we need well-identified monetary policy shocks, which means that they should capture unpredictable and exogenous variation changes in policy. They should not be predictable by other, let's say, macroeconomic shocks. Let me start with a simple monetary policy rule, just to put things in perspective. So we have, let's say, a policy instrument, interest rate. Then the central bank is going to respond systematically to the inputs to the rule that, let's say, the things that the central bank cares, inflation, output gap, unemployment, so in a systematic way. And then there's this extra part, which is the deviation from the systematic monetary policy, which we call a monetary policy shock. Now, note here that I'm allowing that this systematic response to vary over time. So we have a phi t. The conventional empirical strategies that have been used in the literature to identify monetary policy shocks typically assume that the rule is constant. So the systematic part is not varying over time. And we have these assumptions in identification strategies that use linear Taylor rule regression, so the famous Romer and Romer type of shock. We put all the information that the central bank knows and cares, and what is left unexplained, the residual is the shock. We have this assumption in linear structural VARs, independent of what type of restrictions you are using for these VARs. But we also have this assumption in high-frequency identification. Now, the question is, can we identify true monetary policy shocks when systematic monetary policy actually fluctuates over time? And the simple answer is no. We will have a contamination, and said in very simple words, we are going to put in these shocks, we are going to mistake intent for surprise, where intent is this, let's say, variation in systematic monetary policy. So what we are going to do, we're going to do two things. First, we are going to show, in theory, this contamination problem. We're going to show that conventional identification strategies, they are going to yield to empirical monetary policy shocks that are contaminated by other shocks. They are predictable by variation in systematic monetary policy, but this doesn't end there, that we just have, let's say, contaminated shocks. But when we want to understand the effects of monetary policy shock in the economy, we're going to get biased results. So we're not going to identify the correct effects of monetary policy. Then we're going to show some empirical evidence of this contamination and this bias using, for the case of the US, so for the Federal Reserve, and we're going to use, let's say, some very famous empirical monetary policy shocks, like the Romer and Romer, some improvement on the Romer and Romer, Miranda-Agrippino shock, and we are going to show that these are predictable by variation in systematic monetary policy. And we have a crucial measure that is this variation in systematic monetary policy, which is represented by the hawkishness of the FOMC, which varies over time as members rotate their voting rights or, let's say, resign, or there are new nominations. So this is going to bring this time variation on who is deciding monetary policy. And we're going to show that these shocks actually are predictable by this time variation. Then we are going to clean these shocks by this predictable part. We're going to get these new shocks and showing that the effects on the economy of these shocks actually are stronger and faster. So we have not so much lags of monetary policy than we previously thought. Now, with regard to the literature, this is a long business of 30 years of identifying monetary policy shocks, so great contributions in the literature. And this challenge that monetary policy might vary over time, this challenge, of course, have been recognized in the literature. What we are bringing here, we are formally characterizing this misidentification and proposing a solution for it. Also, the literature has, let's say, has works that tries to work with this time-varying monetary policy as a latent variable. But this literature actually shows very clearly the challenge of identifying the systematic part of policy from the data and the modeling choices. We're proposing, let's say, a measure that is outside of the model, and we're going to show that this time variation actually is going to give us very sensible and important results. Very briefly on the theory part, what happens if we apply conventional identification strategy in an environment when the systematic monetary policy is time varying? Again, the monetary policy rule that has this phi t that varies over time, but what these conventional strategies are going to use is a constant rule, okay? So we are going to estimate this EM, empirical monetary policy shock, and this, let's say, this type of regression applies to Taylor rule regression, linear VAR models, and high frequency has a similar problem, but I will just speak about it later. Now, if you combine these two regressions, you can do some, let's say, calculation and arrive at this proposition where the monetary policy shock, the empirical monetary policy shock, will be the true shock, the WM, plus something else. This plus something else, there are two wedges, which one edge is the first that if we are using OLS, we kind of knew this problem of misidentification. Using an OLS, we might have hard time to get the right phi, this average response, because of identification issue. XT also might be affected by the monetary policy shock. The second wedge is what we are kind of bringing forward is this now we are going to put in the residual the interaction of phi t with xt. So this interaction now will show up in the residual, and this is the contamination that we are bringing forward through this time-varying systematic monetary policy. Then you might want to do some impulse responses. So to use this empirical monetary policy shock, assume you are interested on the response of inflation to the empirical monetary policy shock. We do a local projection. However, now we know that the empirical monetary policy shock contains the true shock, but also these two other parts that are problematic. So this leads to bias in the RF, in the impulse responses. So this means that the monetary policy shock actually will depend on macro shocks through pi t, but also will depend on the interactions of macro shocks with the systematic monetary policy. How to kill this? You want only if this phi t is 0, so there is no time variation, or phi t is exogenous and xt is exogenous at the same time. So then it means that monetary policy does not affect the economy, so economy moves for its own reason, and monetary policy moves for its own reason at the same time. Now we have a testable prediction whether this interaction explains some variation in the empirical monetary policy shocks that have been estimated in the literature. I said that we have this problem also in high-frequency identification. What is the problem here? Now we have, let's say, the interest rate changes around the monetary policy event. So we have the expectation, then we see the monetary policy news or decision, and then we see the, let's say, what is the interest rate after this decision. We do this change, and this change, based also if we can use the regressions that we had before, represent the true shock, but also two other components. One is the so-called update about the XT, which we call information effect, central bank information effect, and the other part is update about phi TXT. So it's update about this interaction. Assuming that there was no update about the data, so markets were not surprised about the data, so there is no information effect, that what remains is that market actually were surprised on the change, that the rule has changed. So they had a perception on the phi t, and after they saw the decision, they think, the rule maybe was different. So now you see that the empirical, this monetary policy price, is contaminated by variation in this systematic monetary policy, even in these very high frequency events. There is recent literature actually that accounts for this, or at least mentioned that there is this extra component in this monetary policy surprises. So Bauer, Swanson, Erczynski, Karate, they speak now about this Fed reaction to news. How they deal with it is not so they have not arrived yet there to deal with this part of the surprise. We are also not yet there, but we are working on it. Let's go now to the empirical analysis very fast. Now we know what is the prediction. We will get some of these shocks, Romer and Romer shocks and others, and we will see whether this phi t, this interaction with systematic monetary policy and inputs to the rule have some explanatory power from these shocks. But before, what is our measure of systematic monetary policy? We start from who decides monetary policy in the US. And these are the members of the FOMC. These are 12 voting members, 7 from the Board of Governors, 5 regional Fed presidents. These people are not static. So we are studying FOMC since the 60s. There have been more than 140 people that have been sitting on that table. So people rotate, which means preferences rotate, which means that who's deciding monetary policy actually is varying over time. And one reason why these people rotate is the voting right. So every year, 4 regional Fed presidents, they rotate their voting right, which is with a mechanism that is completely exogenous to the state of the economy, which induces plausibly exogenous variation. We have people sitting there, but how to use them for our purpose? I have built a measure of characterizing these people as hawks and doves with respect to the dual mandate, where a hawk is a member that leans more towards, let's say, low and stable inflation, and a dove more towards supporting growth and employment. And I'm following these people before the meeting. I'm looking at the media. What is the perception about this leaning for each member? So in a meeting, before the meeting, we can do the aggregation of preferences as I have, let's say, 12 members. If you are a hawk, you get +1. If you are a swinging hawk, because I also have people that swing over time from hawk to dove, you get a lower weight. You might be completely unknown. You just started your FOMC stint. Nobody heard about you before. You didn't have a speech before. You probably were in the private sector. There is no news that tells something about your policy preference. So you start with a 0, and so on. So we aggregate these preferences, and this is our phi t, so our measure of systematic monetary policy. Now, this phi t, let's say, is out of a model, which for us avoid specification of a particular rule. So we are studying FOMC for 60 years of data. There have been different policy instruments, so a lot of has happened in this time. So we're saying we don't know the rule, but we know the hawkishness of the FOMC. So we can apply that as our measure of systematic monetary policy. Of course, these are perceived preferences, and I have done a lot of validation in previous research to show that these perceptions, actually, they match what we can observe later, because I'm seeing these perceptions in real time, and then later we see their votes, we see their forecast, we also can see their descents, so I can match and see that a perceived hawk is actually one that usually will descend for higher rates and so on. Then we have other validations that these preferences actually are linked to early life and to their education, so it's something quite persistent, and that this variation in hawk and dove scale can explain a sizable variation in how different shocks transmit to the economy. So we have evidence that for government spending shocks, but now in a revision we have evidence that actually it also matters for how how oil price shock transmit to the economy, TFP shocks, so this is really powerful. This is how the measure looks like. In red is the hawk-dove measure for the full voting FOMC, and in the dashed line is the measure for the rotating members. And you see that it varies a lot over time, and one reason is because there is this rotation of voting rights. Now, let me use this measure and go to Romer and Romer, the seminal Romer and Romer shocks. And although now, today, we just spoke about monetary policy surprises, but keep in mind that for many other countries, it's not possible to construct monetary policy surprises. So we still have to use let's say, the methodology of Romer and Romer, assume that there is a reaction function, put information to it, and get the residuals. So this is what they did. So they put green book forecasts, they get the residuals, and now what we're going to do is take these residuals and put these interaction terms and see whether they have some explanation for these Romer and Romer shocks. We're going to also add some lags with the idea that maybe monetary policy, we know actually from let's say, FOMC members saying themselves, when I'm going to the meeting, I'm actually going to position myself for the decision of the other meeting. So I want to influence the colleagues for the next decision. So we add some lags. We also look at the full hawk-dove measure or just the rotating measure. And we're going to look at different samples. And what we show here is the R-squares of these regressions for when we use the full hawk, the rotation hawk, for different samples, subsamples, and different lags. Now, what we see that actually we get quite high predictability of these shocks. And let's say the best model or the best regression is the one with the rotation of hawks and with lag 1, where we can have up to 50% explanation of these Romer and Romer shocks. We also see that which are the quantitatively important regressors, and it is really the interaction. So the interactions of hawk with XT. So not just the hawk itself, the level, but is the interaction what is important. And we show this for other shocks, not just Romer and Romer shocks. So another shock is Aruba-Drexel, which is a refinement of Romer and Romer shocks, with adding more information from Green Book forecasts. And the Miranda-Agrippino-Rico shock, which is coming from the VAR, where the shock is actually informed by high-frequency monetary policy surprises as an instrument. Now we are going to clean these shocks and show impulse responses to these new shocks. For interest of time, I'm going to concentrate only the Romer and Romer shocks. So we're going to clean the Romer and Romer shocks and show the impulse responses to both shocks, the new and the original shock. We're going to focus here on the sample 1983 to 2007 because this is considered in the literature as a problematic sample that brings puzzles, output puzzle, price puzzle, and so on. So here are the results. I'm going to show you two panels. The first panel, I'm going to concentrate in the red. These are the responses to the new shock, and in black is the response to the old Romer and Romer shock. In the second panel, I'm going to highlight the uncertainty or confidence bands of the old shock. So you can see also the confidence around these responses. So we have a tightening shock. We have, of course, we have standardized them to be similar. So we have a 100 basis point increase, like the maximum increase of the Fed funds rate. And you see that the new shock has a more transitory response. So we have a tightening that comes back much faster than the old shock would suggest. However, we get a much stronger GDP response with the new shock. So we have almost the doubling of the effect of the dip of GDP response. And if you see also that with the old shock, this response actually would be almost insignificant. So this drop in GDP. What happens with prices? Again, we have a strong response of prices with the new shock, but also a much faster response. So with the old shock, we would see a response after 2 years. So there are really these long lags of monetary policy. With the new shock, the prices are going to react actually in 1 year. Now, we have a bunch of other results. We decompose the Romer and Romer shock to see actually what is the part of systematic policy that is biasing these responses. As I said, we have Aruba-Drexel shock, additional variables, and many, many others. And if one can click on the last one, on this go, one can help. On the last, yes. So this is the responses if actually we are going to just include some lags of XT without interacting with the Hogg-Dove measure. You see, there's no difference. So just adding more information set to this regression is not going to clean the shocks. Why I wanted to show this, because this is important to understand that what is this interaction telling us? It's telling that if it really matters, so if you have the data, who is looking at the data? Are we looking at them with hawkish eyes or with dovish eyes? And these hawkish and dovish eyes will vary over time. So if you see a 4% inflation, this will be different for a hawk than for a dove, and they would want to react differently to it. So this is really important. So it's not just the data, it's who is looking at the data. And usually this information is missing in our typical, let's say, regressions that don't have this information that we can get out of the model. So if you go back. Great, so just to conclude, I showed here that in theory, this presence of time-varying systematic monetary policy poses challenges for conventional strategies used to identify monetary policy shock. This is not actually only about monetary policy shock. You can apply this very well to fiscal shocks, because that is as well, if we consider that is a reaction function that may vary over time, the same problem would apply there as well. And our evidence highlights that these challenges actually has important importance. So it's relevant for this, how we think about how fast monetary policy shocks transmit to the economy and how forceful. And the new monetary policy shock that we provide shows that monetary policy transmission in the US is quicker, stronger, and more significantly than we previously thought. Thank you.
Thank you, Klodiana. And Francesca, you have 10 minutes for your discussion.
Thank you. Thanks a lot for inviting me to discuss this really nice paper. Let me start by giving you a brief overview. As I'm telling you, it's a really nice paper that starts from a very insightful and simple but overlooked observation that indeed, if you have a monetary policy rule that is time varying, but the econometrician estimates a non-time varying Taylor rule, then you're going to get estimated monetary policy shocks that will be confounded with the time variation. Okay, and so I'm just showing you effectively what Klodiana was showing you before, where, to get a sense of this confounding effect, you just put together the time-varying policy rule with what is estimated by the policymaker, and you're going to get two effects, one that has to do, a bias, if you want, that has to do with simply the estimation, the fact that we might not estimate phi perfectly, and then something that has to do with the time variation and the difference between what is expected of this time variation and, and the time variation itself. So that part will be something I will come back to, and the expectations on it, because it's something that I'm interested in and that I feel is slightly missing in the paper. Just to summarize, so the paper proposes to use this hawk-dove balance to measure the time variation in the policy rule, and then they show that there is contaminations of various shocks that are used in the literature, the Romer and Romer shocks, but also the Miranda, Grippino, and Rico that are high-frequency shocks. And they show that they can be predicted with this hawk-dove measure, and therefore propose a new identification strategy that cleans from these effects of systematic changes in the monetary policy rule. So let me start by giving you an overview of what comments I will have. I will have three sets of comments. So the first is really about the nature of this time variation in the Taylor rule. What does it stem from? I will ask or probe a little bit more about what this hawk-dove balance measure is picking up. And then I'll have some smaller points, which I'll probably not have the time to get to. Okay, so let me start with the source of the time variation. As also Emi Nakamura, for example, pointed out in Jackson Hole this year, Taylor rule, is probably more descriptive than normative, and indeed seems to be fitting mainly during the Greenspan era. So this suggests that indeed there is time variation in the Taylor rule. And if you want to kind of have think about how monetary policy maybe is set, there's more, you could think about policymakers having a loss function on output deviations and inflation deviations, where lambda is the weight on output deviations. And then, now I'm kind of very simplifying it a lot just to give you the flavor of the reasoning behind, but if you do optimal policy without commitment in a standard New Keynesian model, well, then this optimal monetary policy implies a policy rate that delivers, this relationship that you see on the slide between output deviations and inflation deviations. And this relation depends indeed on the central banker's preferences, lambda, for output stabilization, but also on the slopes of the Phillips curve. So now if you were an econometrician doing your regression on the Taylor rule, you would find time variation in your coefficients, but this could be due to variation in the lambda, policymakers' preferences, but also time variation in the kappa, the slope of the Phillips curve. Okay, and indeed, considering that there has been a debate about the time dependence and time variation in the slope of the Phillips curves, I'm just asking whether can more be done to say whether really this does come from the lambda or other elements of the economy that are also having time variation. The other point that I want to make, which is still about what this time variation is about, has to do with what the agents know. So in your model, you have this time variation phi t, but everybody is fully aware that there is this time variation. But this is a strong assumption. And actually, it's more realistic for me to think that agents would be learning about this, extracting a signal. So in this sense, misperception about the rule. And that's exactly what the Bauer and Swanson, for example, talks about. So they posit a drift in the Taylor rule parameters, as you do, but then there's also systematic underestimation of the Fed's response, informational rigidities. I discussed a month ago Rico and Savini's paper, who argue that this, this drift effect is actually only second order. There's another way, and this is what I find more interesting, but of thinking about misestimation of the Fed's reaction, where you can think of different confidence in the public signal between the public and the policymakers, which generates heterogeneous priors. And so with my co-author Riccardo Mazzolo, we have a paper where there's time-varying public confidence about the implementation of the monetary policy rule. And we implement this in a model with, it's a simple New Keynesian model, but where households are ambiguity averse. And there you get first-order effects. Effectively, you have ambiguity-averse households that base their consumption-saving decisions on a distorted belief of the prevailing interest rate, which is going to give you both the belief of the interest rate that is below the one actually implemented by the Fed, as found, for example, by Bauer and Swanson, but also it gives you implication about long-run inflation expectations and trend inflation that match the data. And so my point being, I think the perception about the rule are really important, and it could be that the time variation is coming from that. The other point that I want to make is about the Hawk-Dove balance, which, on just a cursory kind of look, does seem to be moving also with the business cycle. The other point that I want to make is that I'm not sure that an average of the opinions of the FOMC is really necessarily representative of ultimately what happens with the decisions, because there is, influencing and, consensus building, etc. The last point that I want to make regarding the Hawk-Dove balance has to do with the fact that when you build this measure based on newspaper, on the perception of the newspaper of what these central banker preferences are. But actually, you could probably, go ahead and use the speeches directly. Which might give you a better measure of how hawkish or dovish these members are. So on the one hand, I think the measure you're using really points to the importance of actually accounting for perceptions and misperceptions. But also, the point that I want to make, and because I've been playing around with these speeches, is that actually if you use the text from the speeches, you can also you can use the text from the speeches directly to clean some shocks. So I had been playing around with this for my discussion of Giovanni Rico's paper, so I'm showing it to you here. But just to say that, when you include a very simple net negativity sentiment score from Fed speeches and testimonies, you can also, see that the sentiment indicator predicts the Miranda-Agrippino shocks, and you can get a series for the shocks. So the Miranda-Agrippino, the original one is in the blue, and the red one is the one that is cleansed with the speeches. Also, it was also a new measure of the shock, and also gives you impulse responses that, remove some of that bias. And so with that, I have some smaller comments, but I'm going to leave it at that. I'll leave you with, just to say this is a really nice paper with a really nice idea, simple idea behind it. Yes, thank you for inviting me to discuss it.
Thank you, Francesca. And Klodiana, would you like
Yes.
to respond to Francesca's point?
Thank you very much, Francesca. Actually, I'm happy that you also had these comments because we have thought about them and they are important. So I will go maybe to some of them. So what is the source of variation? Actually, for this project, the source of variation doesn't matter much because for this phi t xt, for the interaction, this contamination happens independent whether this phi t is moving for exogenous reasons or for endogenous reasons. So if, let's say, there are shocks in the economy and they are affecting the phi t, that will stay in the, actually it makes even harder to kill this interaction. And if we go then to the data, yes, actually a good feature of the Hogg-Dove measure is that a part of it can actually respond endogenously to the state of the economy, maybe not through the, let's say, the Phillips curve example, but something similar. Let's say we have a president that wants to let's say, to lower interest rate and going to nominate members that will be dovish. So this is one channel through how the state of the economy can enter in the FOMC. But then we have this other part, which is the rotation of regional Fed president that is supposed to bring us some exogenous variation. But for the question of contamination or not, the source of the variation doesn't matter. But whether actually this Hogg-Dove is varying over time, it is varying a lot, and we have shown that in several validation exercises that it explains Fed fund rate changes, it explains how shock transmits to the economy, so this variation is important. Now, what agents know about the rule, I think this is a very important point, and it's true that in the theory model, this phi t is assumed to be observed and to be the perfect one, and not the, but in the data, so the measure that we have actually is the perceived measure. So it's the perceived measure as constructed by media, and if media and market know, it's supposed maybe that also consumers have seen or can do this calculation. So in that sense, it's a perceived rule, and maybe at time this perception might be further from the true rule. And, but as I said, we have a lot of validation that this perceived rules actually matches very well some policy decisions, like how they descend, how they forecast, and what preferences they have, what interest rates they prefer. But these are only when you read the transcript, so we don't know in public. The other one was, I think, which is very important to learn directly from the speeches. So this is very important. Actually, media have been very clever to do that since the beginning of the times. So in the 60s and 70s, when monetary policy decisions were not known, speeches were one of the main sources of information about media to form these perceptions of who is who. So I can think always, I have in mind this quote from New York Times that Paul Volcker had a speech in a university, XYZ, and he said, inflation is our #1 enemy. So in a sense, media is doing the job that now we do with machine learning. What they were doing at the time is getting all the information that they had about these people, what they speak, what schools they did, who was happy about their nomination, who voted them, the liberals, the conservatives. Then 1 year later, they would see their votes. So speeches, all this information is actually what forms the perception about a member. And I'm very happy to see, actually, that this is another validation that then how they speak, it matches with, so we'd expect that a hawk, on average, would have a more hawkish speeches, and a dove, on average, would have more dovish speeches. However, we also have to be careful, and media is very careful. So there are times where a dove has a hawkish speech. It doesn't mean that this dove changed and became a hawk. And the media is very careful to see if this is a change of heart, a hawk turned dove, or is it a change of circumstances? So having a dovish speech from a hawk or a dove having the opposite, this is not going to change the type of the policymaker. But of course, hawks will vote for lowering rates, doves will vote for hiking rates when the state of the economy will demand that. But I'm very happy to see that speeches, like if you just get the raw speeches, they predict, and this is what I would expect, that there is a link between being a hawk and how they talk. So thank you very much.
So great. Now if there is any questions, Fiorella and then Anna.
Thank you, very interesting. I completely see what you're doing with these Romer shocks. It makes a lot of sense, but I'm a bit, maybe I didn't get it. Why is this a problem for the high frequency identified shocks, where you just have the 30 minutes and then you don't care? Maybe the phi has shifted a lot, but you're not capturing that. You're really identifying what else is happening.
Yes.
No, wait. We need the microphone.
Just checking how your shocks after cleaning behave compared to those high frequency identified shocks would be nice. Thanks.
So the point that you are making about the time variation of the systematic response is super interesting, and it's a theoretical concept. But then you're using the US as your laboratory, so you're using some institutional framework, some institutional features of the American monetary policy to test that is time varying. So I was thinking of the euro area and whether we can also think of time variation in the systematic response of the ECB monetary policy, and whether there are some features that could give us that.
We have a third question by Christine.
Is this on? Yes. Can you distinguish between a real change in the monetary policy Taylor rule, or perhaps the media misunderstanding what they are saying and categorizing this as dovish, even though it shouldn't be, and its mistake is driving some of your results? This is, I thought Fiorella will ask this question, to be honest, because it's related to her work.
So Klodiana, you have a couple of
Yes, I thought there were others. Okay, thank you very much for all these questions. So what is the problem with high frequency shocks? So the problem actually is, I don't have now the slides to show, but the idea is that even in this, so this monetary policy surprise that we are getting in this very tight window is going to show you these three elements that have been discussed in the literature. So one is the true surprise. The second element is that maybe the central bank had some superior information that was revealed, so this information effect, but then there is some extra element that maybe there is a change, or because these surprises are based on the perceptions of the market, maybe the rule changed. So they call this Fed reaction to news. But this means that actually market thought that there was a rule in place before the decision. Now they see the decision, and this looks like there was another rule. In our language of the hawk and dove, we have not worked this, and we plan to work with them. In our language, this could be that there was a situation where maybe we had a tight balance of hawks and doves, and the market actually could not assign which rule will prevail the decision. Then they see the decision, and they see, it was the rule of the hawks or the rule of the doves. Or it could be that they were in a situation, there are many of these unknown people, so you don't know actually, you are more uncertain about the rule before the meeting, you see the decision, and now you change your perception on what was the rule. So this is how we can, let's say, put some structure on these rule changing, even in this very tight window. Institutional features, actually the specialty of the FOMC is rotation of voting rights that happened for the whole year. We have this rotation also for the ECB Governing Council, but it happens at a meeting frequency. So this doesn't allow maybe room for these big bargainings and coalitions. Let's just say that probably we can lock some for the whole year. But of course, one can do the hawk and dove story also for the Governing Council. It's a bit more difficult for different reasons, but probably then we can go to this speech if we cannot, to say it simply, you can say you're German, you're a hawk, you're Italian, you're a dove. You don't need to read all the newspapers. But if you want to be a bit more academic, maybe I cannot read, let's say, all newspaper in German, in Italian, and so, but we can do the proxy of doing the hawk and dove from speeches, and there we can get some average hawkishness. Yes, it is time varying because members also Governing Council, they change. So there is new members. There is also swings, if I can use. So there's members who are switching, but there is time variation also in the Governing Council. Maybe not as often, but if we knew the votes, it is much often because actually the voting rights are changing every meeting. So it would be even more higher time variation. Can you distinguish if the rule really changed or media actually? This is the question. So
yeah, you have minus
2 minutes. Okay.
So just
okay.
Quickly wrap up.
As I said, this is the perceived measure, but all these results and validations show that actually those perceptions are pretty close to how they decide. So there might be times when they are not close, but on average they are doing pretty well.
Great. So let me thank the whole session.